Hello, class, and welcome to the sample problems part 1 for chapter M5, Managerial Accounting 5. So this first problem asks about why do we prepare a budget for a company? Like, what are the benefits? And they make this pretty easy. It's got drop downs. So we're just going to kind of talk through these really quick and why they might or might not be a benefit. Budget allows managers to be promoted. That is not a primary purpose for budgeting. Budget ensures that there are no variances. Also not true because variances are differences between what we actually spend on something and what we plan to spend on it. And there's always going to be those differences. So that is also not one of the options. Well, so since we've eliminated 2 out of the 5 and we have to choose 3, that kind of tells us that the remaining 3 must be benefits of preparing a budget. It does force managers to plan ahead and think about what's going to happen in the future. It does promote coordination and communication because the best budgets are formed by having communication between the people performing the work and their managers to ensure that budgets are accurate. And it also encourages communication between departments because the larger, broader budgets within a company have to be added together in order to achieve an organization-wide budget. So definitely a benefit there. And then the last one, the budget provides a benchmark, and that's also true. So a benchmark is a level set where you have something to compare your expenses to, and that definitely does provide a benchmark. So moving on to problem number 2, which budget or budget types should be used to meet the following needs? Okay, so the different budget types that they have listed in here, these are all components of a budgeting process here. So I'm just going to talk really quick here about what some of the types of budgets are. Let me just pull up a picture here for you. 1 second here. Okay, so here we have the components of a master budget for a company. The budget for operations and finances starts with the generation of a sales budget. So you first have to know how many things you're going to sell in order to know how much you need to produce, what your cost of goods sold will be, and then what your other expenses are. So in your operating budgets, which are short-term budgets, usually 1 to 2 years in the future, you start off with your sales and you go from there. Now, long-term budgets are not part of that master budget. They are planning for the future, and any type of long-term management is typically considered strategic management. So a strategic budget is a budget that would be planning for long-term for the next 5 years. All right, so here we have a store manager wants to plan for different levels of sales. Well, so when we plan for a single budget at a single level of production, then that would be considered what is called a static budget, okay? And so we have to come up with some kind of like number, like base number to start with, like, hey, what is the most likely number for our sales for next year? And that would be a static budget. However, it's also helpful for us to know how much that would change if we were to have different levels of sales. So we prepare what is called a flexible budget for different levels of sales. So that would be flexible budget. The next one they're asking about, an accountant wants to determine if the company will have sufficient funds to pay expenses. So that would be this cash budget portion of our master budget. That's where we plan out like how much cash we plan to have and when. So when does cash come in? When does cash go out based on our planned sales and collections? And then the last one, the CEO wants to make company-wide plans for next year. So for 1 year. So that would be this master budget that covers all the different parts of the company from sales to production, manufacturing, capital expenditures are our investments in long-term assets, when will our cash come in and out, and then what are our financial statements going to look like. So this one is the master budget here. Whoops. So let's see here. It looks like they're wanting master, operational, and static on this one. All right. So including, so all three of those, I guess, technically, but overall, it's the master budget there. All right. Looking at our next problem here, we are going to be looking at how we can put together a sales budget, okay, which is the base starting point for your budget. So to calculate a sales budget, typically this is going to get figured out by your marketing department, whoever analyzes what the current market is for your products. But we've got Kendall Company here who projects that their first quarter sales are going to be $10,000, and then they are going to increase by 5% per quarter. So for the very first quarter, it's just going to be the $10,000. And then all we have to do is increase the previous quarter's amount, right, times 1 plus 0.05 to get us to 5% more. So 1.05. So here we're going to take $10,000 times 1.05. Whoops. And then, oops, C9 would help if I had the right letter in there. There we go, 10,500. And then the base amount for the next quarter is going to be the previous quarter's amount. So set that equal to D9. And then this is just going to be the same multiplier per quarter here, right? And I can use the same formula here. So this is going to, again, take the previous quarter's ending times the 1.05. So if I copy this down, and then I copy this down, it will grab each previous quarter, multiply it times 1.05 to get to the final amount. They are rounding these off here. So we'll want to watch out for that part. So this is going to be the 10,500. And then we're going to have that just pulls down. And then here we've got 11,576. And then they're just having us go through 4 quarters here. So we actually can skip this last one, add these all up. And that gets us to 43,000. Whoops, hold on a second here. 576, 11, 0, 10. Oops, this should be 10,000. There we go. So 43,101. And that's how we just do this basic sales budget. Okay, so now we have Friedman Company, and they're manufacturing and selling bicycles. A popular model is the cross country. They expect to sell 1,500 cross countries in 2024 and 1,800 in 2025. So at the beginning of 2024, they have 350 sitting in their inventory, but they want to have 10, and they want to have 10% of the next year's sales available at the end of the year. So how many do they need to produce? Well, what we need to do is put in here the budgeted numbers that are going to be sold, right? So we're budgeting, let's see, 1,500 to be sold. So we're doing first a budget for the units, right? And then once you do the units, then that you need to have in inventory, then you go on and do a full production budget that determines costs associated with those units. So we want to sell 1,500, plus we want to have 10% of the next periods in inventory at the end, so we don't run down to zero. So if we're planning on selling 1,800 next period, then 10% of that is 180. So desired items to be in our ending inventory is 180, which means that in total for this month, we need to have 1,680 units, okay? Now, if we need 1,680, we will subtract from that what we already have, which is our beginning inventory of 350. And that is going to get us to a need of 1,330. So 1,680 minus the 350 gets us to 1,330. Okay, so that is that problem. For our next problem here, we've got Brown Company manufacturing luggage sets, and they sell those to department stores. So we're expecting to sell 1,700 luggage sets for $180 each. And so they're just saying, hey, what are our total sales going to be here then? So 1,700 units times 180 units gets us to 306,000. And then in February, we are looking at selling 2,050, also at 180. So that's going to get us to 369,000. Okay. So I'll just copy those formulas there in case anybody didn't keep up with that. So you can pause that if you need to. And that was how we calculated it, right? Just multiplying the number of units needed times the price per unit. All right. For the next one, we have another example of budgeting our units of production here. So it's going to be the same concept here. Budgeted units to be sold plus our desired units and ending inventory will get us the number of units we need. From that, we will subtract out our units in beginning inventory here. So Bailey Company expects to sell 1,500 units in January, and their desired ending units are going to be 80% of the next month's sales. So next month, we are planning on selling 1,750. And so if we multiply that times 0.8, that gets us to 1,400 units we need to have at the end of the month for a total of 2,900 units. We had 180 on hand, so 2,900 minus the 180 gets us to 2,720. Now, next month, as we said, we're going to be selling 1,750, and we want to have 80% of March, so 1,820 times 0.8 for March, which they gave us the March sales up above there, tells us we need to have 1,456. So in total then, that gets us 3,000, oops, hold on, let's see, 1,750, I did a typo there, go. 3,206 units needed. Now, we'll have a lot higher inventory here. How do we figure out this units in beginning inventory? Well, it's the previous period's ending inventory. So this is just going to be the 1,400 we calculated to have at ending inventory the previous month. So taking the 3,206 minus the 1,400 gets us to 1,806. Okay. So we're cruising through these here. For the next problem, we need to prepare a direct materials budget. So we need to incorporate how many units we're going to be producing, and we need to take that and multiply it out times the number of units of raw materials and labor that are going to be needed for production. So for this one here, we need to start off with our budgeted units to be produced. So we're expecting to produce 1,800 units in January and 2,155 units in February. We budget 3 pounds per unit of direct materials. So for each of those, we're going to take it and multiply it times 3. And taking the 2,155 times 3. So for January, we need 5,400 pounds. And for February, we need 6,465 pounds. Now, Plus, we're going to add into this our desired direct materials that we want to have in our ending inventory, okay, in terms of pounds. So let's see here. So let's see, balance in raw materials indicated is 4,950. We desire our ending balance to be 20% of the next month's direct materials. Okay, so we're going to take this one, multiply it times 0.2, and that gets us to 1,293 that we want to have here. For desire, and they gave us actually the desired ending balance for February of 4,860 pounds, which is a lot. All right, so then we're going to take the materials needed for production plus our direct materials we want to have in ending inventory here. And that's going to give us the total that we need to have in terms of pounds of materials. Okay, so here we will need to have 6693, and over here we're going to need to have 11,325. So I'm just adding these two numbers up. Okay. All right. So the next part of this budget is going to be that we need to subtract what we already have. All right. So direct materials that we already have. Let's see here. So balance in raw materials is 4,950. Now, the balance in ending in materials here is going to be the previous month's desired ending inventory, which we calculated here. All right. So then that means that we need to take, let's see, C10 minus the ending inventory. So we need to purchase 1,743 here in terms of pounds. And over here, we're going to need to purchase a lot more, 10,032 pounds. And then they tell us that the cost of direct materials up here is $10 per pound. So if we multiply the pounds we have to buy times the cost per pound, then that gets us the dollar amount cost of our materials purchases. And that is problem number 6. Okay. So for this one, we're doing a direct labor budget. So again, with labor, we do this kind of a similar process to what we did on the materials, and we need to start off with our budgeted units to be produced. So we expect to produce in this problem 2,050 units in January and 1,994 in February. And guess what? We don't have to worry about inventory with people. So we can literally just multiply this times the direct labor cost per unit. So our cost per unit is 5 hours per unit at $12. So here we're going to take this and multiply times hours per unit to get the labor hours needed for each of these. So 2,050 times 5 gets us 10,250 hours. And then 1,994 times 5 gets us 9,970. All right, and then we're going to take that and multiply it times the cost per hour, which is $12 per hour. And that gets us to 123,000. And 119,640 over here. So I like the format of these questions because it just walks you through exactly how the calculations are being done. So these would be a good one for you to look back on when you do the homework in case the format isn't quite so comprehensive and friendly for you. All right. For problem number 8 here, we are going to be calculating our variable overhead. So for this one, we're expecting to produce 2,030 units in January, and we are expecting to produce 2,210 units in February. And just like our other previous two budgets, we're going to calculate out how much we think our overhead will be based on how many units we're going to produce. So we'll go ahead and plug those in here. So the total across the two is 4,240. And our variable overhead cost per unit, we are budgeting $10 per unit for each of these. And that's going to be the same across the board. So multiplying the number of units times $10 per unit. And then next we need to look at our budgeted fixed overhead. Now, fixed overhead by definition, so variable overhead is a variable expense. It goes up based on how many units you produce, right? That's what variable expenses do. Fixed costs, on the other hand, so fixed overhead stays the same regardless of how many units you produce. So here we are going to take a look at one second here. So we have here 2,100 per month for depreciation. Not going to change, don't have to do any math, just add those together. And then our other fixed overhead costs they provided us were 78,460. So we'll just add those together. 156,920. And then total budgeted fixed overhead is just the total there. So each month, 80,560. And multiply that times 2 for the total column. Gets us to 161,120. And then in total, then we add the budgeted variable to the budgeted fixed to get the total overhead. 20,300 plus the 80,560. So per month, for the first month, 108.60. We do have to do these separately because they had different variable amounts. So 22,100 plus the 80,560 in month 2 gets us 102,660. And then when we add those together, I can see here it's summing this because I highlighted it, 203,520. Adding those together. All right, then in terms of labor hours, they gave us labor hours required 8,120 hours, which they told us up here for the first month, and then 8,840 for the second month, for a total of 16,960 hours. They're using this direct labor to allocate out these costs. So we added up here our total budgeted costs are 103,520. We're going to take that total and divide it by the number of hours to get a rate of overhead to charge out per hour. Just like we're doing a predetermined overhead, right? So dividing the total budgeted overhead by the number of labor hours, since we're using labor to allocate that out, gives us a rate of $12 per hour. Okay, and I'm going to wrap this video on that question. I will do the next 4 questions on a second video here.